The best of Money Matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin, Jeong. In recent years, private markets have surged in popularity across Southeast Asia, with Singapore emerging as a pivotal hub, accounting for 45% of the private equity market in both deal value and volume in 2024. This growing interest reflects a broader shift among investors seeking diversified long-term growth opportunities beyond traditional public markets. As allocations to private markets among retail investors are expected to rise in the coming years, understanding the nuances of these investments becomes crucial. So what makes private markets an attractive proposition, and what are the key risks investors should be aware of? Well, to explore these questions and more, we'll dive into the life cycle of private market investments, their advantages over public markets, and the potential pitfalls that lie ahead. And joining me is Lorraine Tan, who is the Director of Equity Research of Asia, and Wing Chan, who is the Director of Manager Research at Morningstar. Welcome to the show.
Afternoon.
All right. Thank you so much both for joining me today. Well, private markets have grown increasingly popular in recent times, especially here in Southeast Asia, with Singapore accounting for 45% of the private equity market in deal value and volume in 2024. So, Lorraine, why are more listed companies choosing to go private?
I think there are a variety of reasons. I think for companies that have been perhaps listed for some time and they're not getting the investor interest, valuation may be lower than what they had anticipated, and they're not necessarily needing to raise capital publicly. That means there probably is a reason to go private in that sense. It doesn't hurt them in their opportunities to raise funding in the future.
Okay. Well, Wing, then how are private markets becoming more attractive to investors? I mean, what specific characteristics of private markets make them attractive to retail investors with a long-term investment horizon?
Yeah, I think one thing that's certainly appealing more to the retail end of the market is that greater accessibility. So private market investment used to be very much reserved for institutional investors. Now retail investors are able to access many of these private assets through, multiple kind of fund vehicles that they are now able to access. Now, of course, if we look into the asset class appeal, of course, in private market access, it does have that potential to generate a higher return through what we call the illiquidity premium and active management. And let me dive into that a little bit. Now, the illiquid premium is really referred to the additional return that the investor would expect if they aren't able to realize the value of the asset immediately. So one good example of that is residential property that many of us own ourselves. Obviously, we can't liquidate that immediately. The other one is active management. It is related to how, private equity or credit managers are able to add value through active engagement and improving the operational performance of these companies. And lastly, private market assets also offer diversification benefits for investors, because if they are traditionally invest in public markets, adding private market exposure to the portfolio can bring those diversification benefits as well.
Okay. So, Lorraine, does this mean public markets are losing appeal to new companies?
I think it may prolong. There are a lot of factors going on, obviously. It may prolong when a company may want to list if they're quite, adequately capitalized or being able to fund alternative or relatively attractive sources of funding from the private space. Why not continue to do that? But ultimately, I think most shareholders, most investors in private companies do want to exit, and that's where the listing on the exchanges comes through. So we still expect most companies to list eventually, and it's just a question of whether they can get the valuations to make that listing worthwhile.
Okay, well then, given the growing popularity of private markets in Southeast Asia, particularly in Singapore, Lorraine, how do you see public markets maintaining their attractiveness to investors?
I think the Singapore markets has challenges in terms of the trading liquidity. I think one of the reasons it's been difficult to attract really, larger companies to come to Singapore to list is because you don't have that trading liquidity that does generate, share price movements, interest from more, investors, and both institutional and retail. So I think the situation for listings in Singapore is a little bit more challenging, something that the MAS is obviously aware of and is introducing programs to address. But I think for private markets, private companies, we are still seeing a desire to list, let's say, in the US or in Hong Kong, where the markets are bigger and more liquid.
Okay, so Lorraine, what are the main benefits then of staying private instead of going public?
I think from the major shareholder perspective, I think once you're listed, there's obviously additional requirements, both from the regulatory front, obviously from transparency and governance aspects as well. I think the nice thing for some people about staying private is that you don't have this additional need to be as transparent and to report or respond to queries.
Okay. Well, Wing, private markets are set to outperform public markets during crisis. What factors contribute to this resilience?
Yeah, so I can certainly understand where that perception might come from, but unfortunately it doesn't quite provide a full picture because private market assets are not listed. Their value is not marked to market. We don't see the day-to-day volatility like a stock that's listed on a public exchange, for instance. So that is not to say that the value of these assets won't come down during a crisis. Rather, it's more like a delayed impact until the next time those assets are getting valued. And in fact, in many of these fund vehicles, when the investor rush to the exit, fund managers might actually gate redemptions and investors may need to wait for some time before they get their investments back. So ultimately, it really is important to focus on underlying assets and assess how sensitive they are in a crisis. In a financial crisis, a publicly listed utility company might well be more resilient than a privately owned investment bank, for example.
Well, earlier this year, the Monetary Authority of Singapore unveiled and sought feedback on a framework for retail private market investment funds in a bid to offer a wider set of investment options. So, Wing, how might the rise of retail private market investment funds, as proposed by MAS, impact liquidity and valuations in public markets?
Yeah, it really remains to be seen. If we were focusing on retail investors in Asia and Singapore, we do understand that they're generally underinvested. So I wouldn't expect a rise in private market investment funds would automatically lead to impact on public market liquidity and valuations. And it's also worth noting that institutions typically make up quite a big part of public markets, and they have had access to private markets for some time. So it is plausible to see public and private markets both doing reasonably well.
How will this framework then impact the growth and accessibility of private markets in the region, Wing?
Yeah, I think it is a positive development. It provides retail investors with more options to access private market investments. We were previously hard to access, especially when compared to institutional clients. The increased accessibility can drive capital into private markets, support future growth and innovation in the industry. That being said, we do advocate for robust transparency and disclosure measures to protect retail investors from some of these risks and allowing Singapore to be a key hub for private market investments in Asia.
Very interesting. Well, Lorraine, do you think the increasing allocation to private markets by retail investors could lead to a decline in public market participation?
It's possible because you're talking about, the same wallet share, which is a fixed amount. If retail starts to allocate more of those funds to the private space, then, public equity markets, you're going to see a little bit less of that. But at the same time, I think it's just, I think how a company performs or how a market performs is obviously based on what the valuations are and what the quality of the assets are. So if you've got good quality private assets, why not? It's going to be attractive to the investor. Similarly, if you've got, an expensive equity marketplace, then you may not want to allocate as much to the public space when valuations are high. So those, it just depends on what's available in terms of attractiveness at the given point in time.
But Lorraine, what risks do investors face when more companies stay private?
Yeah, so for us, obviously, if the quality companies don't list, obviously, I think the public equity investors do lose out, and that's unfortunate in terms of being able to invest in better quality equities. I think the retail market still will find it easier to access, public equities. It's generally more transparent in that sense, and liquidity is there. I think those are two key factors in terms of sort of reducing or containing the risks of investments. So if you need to sell, it's easier to sell public equities than it would be a private asset. I think one of the things to watch out for is also what's going to be happening in terms of overall macro conditions, what happens with the, private credit space, whether that impacts some of the private markets as well, private assets. The quality of those is a little bit harder to see. And I think that's one of the reasons I think public equities will still remain a key component of most investors' portfolios.
Well, are regulatory requirements pushing companies away from public listings as well, Lorraine?
I think at the end of the day, it's still going to boil down to the valuations, what you can get in terms of the value of the company. If it's fairly reflected in the marketplace, I think there's, more incentive to list. Obviously, if you need to raise capital, if you're a growth company and raising capitals through the public equity markets is still cheaper. I think that's where the attraction to list is as well.
Okay. Well, overall, how should investors rethink about, balancing exposure between public and private markets here, Wing?
Yeah, I think from a perspective for the retail investors, they have traditionally focused more on public markets. So that leaves significant room for growth in terms of the private market exposure. But as we have talked about, private market investments can yield very varied outcomes. And it therefore makes it crucial for investors to thoroughly evaluate each opportunity. Investors, we advise them to ensure that they have an adequate time horizon because these are long-term investments, and also consider liquidity risk because these assets are typically not listed. So it needs to fit within the long-term financial plan and before they commit to making such investments.
Right. Well, then what trends should we watch in the private capital space in the next few years, Wing?
Yeah, so we certainly expect a very robust product pipeline in terms of many of these evergreen funds. These are open-ended funds that are available to many retail high net worth investors with periodic subscription and redemption window, be it monthly, quarterly, semi-annually. And we expect them to come from both traditional asset managers and specialist private asset managers targeting the retail market. We've seen that in Singapore, in Asia markets, in the US, a lot of launches in the US. They're called initial funds. It's a massive launch, growing by about 40% per annum for the last 10 years or so. We're seeing a robust pipeline in Europe when it comes to LTIFs and ETAFs. And given the quantum of launches in products around the world, including in Singapore, we would advise them to be doing thorough due diligence to these kind of products because they invest in very, very different assets. Because of the way they're structured, the assets they invest in, the outcome can vary really widely depending on how the asset managers source these deals and how they manage through them. And they also need to think about things like liquidity and also the fee structure, which can be more opaque compared to typical retail investments. So from our end, we are launching new ratings to help investors better differentiate the products that are all coming to the market in the next months and years.
Some great insights from both of you. Thank you so much, Lorraine and Wing, for joining me today.
Right. Thank you.
Thank you. Thanks for having us.
That was Lorraine Tan, who is the Director of Equity Research of Asia, and Wing Chan, who's the Director of Manager Research, both from Morningstar. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.